Hello, it's ChewDog Charts. Corporate earnings in the fourth quarter have been stellar, with 80.7% of the S&P 500's market cap having reported earnings by now. 74% of these companies are beating the bottom line estimates. Earnings are topping analysts' expectations by an average of 4.8%. And this is better than the last 3 years. So why the collapse? But more importantly, what happens next? Well, let's take a look. Credit Suisse noted that earnings per share growth in the fourth quarter is expected to hit 15.3%, which would be the second best quarter since the start of 2015. If current earnings continue relative to expectations through the quarter end, earnings per share could rise 15.9% against last year, which would be the strongest quarter for earnings growth since 2015. However, markets have recently been enduring the most turbulent stretch in years, with the major averages falling more than 5%. The 9-day drop of over 10% from peak to trough seen through February 8th was the largest 9-day drop from an all-time high since at least 1980. However, disappointing market performance along with strong fundamentals is not as surprising as it would seem. The reality is that over the past 90 years, the market has ended the year in negative territory 29 times. Of those 29 times, earnings per share was up almost 70% of the time and up double digits close to 50% of the time. Over the same period, the correlation between the annual S&P 500 performance and earnings per share is only 18%. Stock prices are reflections of what investors are willing to pay for future earnings growth. The rally we saw in the stock market last year through the end of 2017 then was in anticipation of the future that exists right now. And the research shows that by the time the really strong earnings performance is realized, investors have already anticipated this change, and by that time, the non-investing public is seeing the abundance of good news about the economy and corporate America. However, the investing class has already started to prepare for the inevitable downturn. Then the relationship between markets and the economy reverses in these later stages of the economic cycle. And we're currently in the late stage of the business cycle, where demand begins to exceed supply and prices increase. That in turn stokes inflation, and it promotes central banks to raise interest rates. Again, higher interest rates means higher discount rates, and thus makes riskier assets like stocks look less attractive. And hence the old adage, good news is actually bad news. Let's take a look at the next chart. According to Goldman Sachs, most equity market corrections recover without developing into a bear market or presaging a recession. The current market is more comparable to 11 corrections that took place during non-recession times since 1976. Among those, 1987 was the only time the stock market ended up crashing more than 20%. And that's not likely to be the scenario this time. According to Goldman Sachs, a bear market would mean the S&P 500 falls from its low of 2535 on Friday to below 2300. Throughout history, market corrections usually happen a little more than once a year. The median decline for the S&P 500 in 16 total prior corrections was 18%, and the S&P 500 typically went down 15% during the non-recessionary corrections over the course of 70 days. If true, a fall of this size would carry the S&P 500 to 2,450, or about 6% below the level last Friday. And looking at this chart here, we can see that the 11 episodes since 1976 have been charted. So from the current level there at the top, we fell down down to that zero line, you can see. And according to their studies, the average return in the dark blue dashed line would probably bring us up a 20% appreciation level from the bottom last week. Now looking at the chart, you can see that there's a 1 standard deviation positive and a negative 1 standard deviation. And looking at the 1 negative standard deviation line from the bottom last week, they anticipate a rise of about 10% by the end of 2018 into January of 2019. But if we were 1 standard deviation above the average, we could actually have a 30 to a 35% appreciation rate in 1 year. All right, take this grain of salt simply because it comes from Goldman Sachs. All right, let's go to the next chart. And so we come to our Elliott wave model. So for you that have seen the previous video on wave theory, you know that there are 5 stages in an Elliott wave model in a motive move or on the move up. And according to a market pundit by the name of Ralph Nelson, he believes that we are now in stage 5 or wave 5. And if you recall, wave 3 is the longest upward trend in a 5-wave series. Therefore, wave 3 was about 4 years in length. Thus, wave 5 can't be any longer than a total of 4 years. And since we're 2 years into this wave, then wave 5 can last at a maximum only 2 more years. However, Mr. Nelson's indicating that, look, the 5th wave may last only a few days or up to that 2-year period. So now let's go to my charts and take a look. So now looking at the SPY, which is the spiders or the S&P 500, over a 10-year period beginning in about 2008 and charting out the wave. Here is the first wave number 1, the second wave number 2, the third wave number 3, and the fourth wave here with the correction, and then the final wave, 5th wave here. Now, we don't know if we're at the end of the 5th wave or not, so we're not quite sure what to expect. Do we expect a correction here, which would be a 3-wave series, the A, B, and C on the downside? Or, according to Goldman Sachs, perhaps we're just in a regular correction and we're going to have some upside here from, say, 10 to 35% or thereabout. Well, let me go to a shorter term chart and show you some of my anticipation and expectation. So let's take a look at that chart. And then this last chart here is the S&P 500, the spiders, but it's on a 6-month daily. And we can see the recent high in late January at this point with the correction coming down to this point here. And right now, it looks like a V formation with the move down, the bounce, and then a recovery to this point here. And although it looks like a V right now, my expectation is that the higher probability is that this will be a W formation. So I'm expecting a stall out in this area here. It may continue on in a recovery, but I'm expecting a stall out. And if I'm right, then it's going to move back down again and have a test of that bottom. And once it tests the bottom, then the other side of the W is going to move on up. And hopefully you can see that after editing. It's pretty far on the right side of the margin here. But as we've discussed before in previous videos, we're going to want to see it move past this midpoint right here. That's the first criteria. And then the second is I want to see how strong that recovery is up to the previous high. So In this recovery, though, this is a pretty dangerous area, and the market is always going to extract from you the greatest amount of pain. And there's a lot of pain in this chart here. So I just want you to sit on the sidelines and watch it recover here past this midpoint if it does a W formation. But I want to see it past here and then up to here, and we'll see how strong the market is at that time, and then we can make some more expectations and decisions on where it might go from there. But for now, I just simply want you to sit on the sidelines. There's always opportunities to buy in again at a point someplace in here when you have reduced the risk. But for now, I just want you to sit on the sidelines and watch and see how this turns out, because we want to see that move past the midpoint and maybe the upper range of that peak. And if it moves beyond that peak, then I think your risk has been reduced quite a bit and you can move in at that time. I am not making that as a recommendation. You're going to have to make your own decisions, but at least for now, I would rather you sit on the sidelines and watch how this all plays out. So for today, that's ChewDog Charts. Thank you.